What if I told you the world owes more money than actually exists? Right now, the global debt has skyrocketed to over $315 trillion, surpassing the total amount of money circulating in the global economy. That's reshaping economies, politics, and potentially your financial future in ways that are more profound than you might realize. This imbalance raises critical questions. How did we get here? What does this mean for the global economy? And more importantly, for you, is there any way to fix this growing debt crisis? The shocking numbers behind global debt. The total global debt has now reached an eye-watering $315 trillion as of 2024. That's not just a number, it's more than triple the global GDP. This means that for every dollar of value produced worldwide, over $3 are owed in debt. To put it into perspective, the global debt to GDP ratio is now hovering around 333%. What's even more astonishing is when we compare this to the global money supply, M2, which sits around $100 trillion. This reveals a staggering gap between the actual physical and liquid assets in circulation and the amount of money owed globally. Essentially, there's not enough money in the world to pay off all the debt we've accumulated. M2 is the amount of money circulating in an economy, including cash, checking deposits, and easily accessible savings. Why does this matter? The answer lies in how the financial system operates. Our global economy is built on credit and the expectation that future growth will cover today's debts. Debt isn't inherently bad, but when it grows at this pace, it signals that we're relying more on borrowing to sustain economic activity. This is especially concerning because a significant chunk of this debt is held by governments, corporations, and households, all of which have to service these debts as interest rates rise. How did we get here? How did we end up with so much debt? Several events have contributed to this massive accumulation. First, the 2008 financial crisis pushed governments to borrow heavily to bail out banks and stimulate economies. Then, more recently, the COVID-19 pandemic exacerbated the issue. Governments worldwide responded with unprecedented borrowing to support citizens and businesses, further inflating global debt. This level of borrowing may have helped avoid immediate economic collapses, but it has left the world with a financial time bomb that's ticking louder every year. The question we now face is, how long can we sustain this level of debt, and what are the consequences of leaving it unaddressed? How debt became bigger than money. Governments around the world have been using a tool called quantitative easing, QE, since the 2008 financial crisis to inject massive amounts of money into the economy. By purchasing government bonds and other financial assets, central banks like the Federal Reserve in the US and the Bank of England in UK aimed to lower interest rates and increase the money supply, making it easier for businesses and consumers to borrow and spend. At the same time, many governments continue to engage in deficit spending, borrowing more money to fund their operations than they collect in revenues. This is particularly visible in countries like the US, where the debt to GDP ratio is expected to exceed 140% by 2054 if current trends continue. This deficit-driven borrowing adds to the already enormous global debt burden, making the financial system increasingly dependent on the expectation of future growth and repayment. Corporate and household debt. While governments have been borrowing heavily, corporations have also taken advantage of low-interest environments spurred by QE. Many companies, especially large multinationals, borrow extensively, not just for growth, but also for stock buybacks, a practice where companies repurchase their own shares to boost stock prices. This borrowing binge contributes significantly to the overall global debt. On the household level, personal debt, whether through mortgages, credit cards, or personal loans, has also ballooned in the last decade. With easier access to credit, people are borrowing more, but the burden of repaying these debts remains heavy. Personal debt now makes up a significant portion of the global debt crisis, further straining the financial system. The combination of heavy borrowing by governments, corporations, and households has led us to a situation where the world owes far more than it has in actual money, deepening reliance on credit and future economic stability. The role of the IMF and debt dependency. The International Monetary Fund, IMF, is often viewed as a financial saviour for countries in crisis, stepping in to provide emergency loans when economies are on the brink of collapse. But what many don't see is the price tag attached. IMF loans come with high interest rates and stringent conditions. While the IMF offers much-needed liquidity, these conditions often dictate how a country must restructure its economy, leaving little room for sovereign decision-making. Argentina, for example, has repeatedly borrowed from the IMF, only to find itself deeper in debt and more reliant on the fund each time. Debt traps and structural adjustment programs. Once a country takes an IMF loan, it can find itself in a debt trap, a cycle of borrowing more just to service the interest on previous loans. Structural adjustment programs, SAPs, are a key part of this cycle. Introduced in the 1980s, SAPs force borrowing countries to implement free market reforms like cutting public spending, privatizing state-owned enterprises, and devaluing currency. These austerity measures can lead to devastating outcomes for the poorest citizens, as seen in Kenya and other sub-Saharan nations, where poverty and inequality skyrocketed under IMF-mandated reforms. The cycle of dependency. Countries in debt to the IMF are stuck in a cycle of dependency, with high-interest payments consuming significant portions of their GDP. These nations are left with little financial flexibility. Instead of reducing debt, they end up borrowing more, keeping them trapped in a vicious cycle of perpetual debt. The IMF's conditions may aim to stabilize economies, but the long-term result is often deeper economic dependency and reduced autonomy for the borrowing nations. The consequences of a debt-driven world. The global economy is no stranger to boom and bust cycles, often driven by excessive debt. When too many individuals, corporations, and even governments take on unsustainable levels of debt, small shocks can lead to massive economic crises. The 2008 financial collapse is a stark reminder of this fragility. During the lead-up to that crisis, US households took on enormous mortgage debt, and when the housing bubble burst, it triggered a global financial meltdown. Now, with global debt levels higher than ever, similar risks loom large. Corporate debt, in particular, has become a red flag as businesses continue borrowing in a low-interest environment. However, when the economy turns south, corporate defaults could spark another financial downturn, dragging banks and economies into prolonged recoveries. Risk of sovereign defaults. As global debt rises, the risk of sovereign defaults becomes more pressing. Countries like Greece have already shown us how severe the consequences can be. During Greece's debt crisis, the country's inability to service its debt led to harsh austerity measures, triggering widespread poverty and economic collapse. This rippled across Europe, revealing the interconnectedness of global financial markets. Today, with many nations grappling with similar levels of debt, a shock in one region could once again have severe global repercussions. Inflation and interest rates, a double-edged sword. In an attempt to combat massive debt and stimulate economies, central banks have engaged in quantitative easing and other monetary policies that often result in inflation. The more money central banks print to cover obligations, the greater the risk of inflation rising uncontrollably. To counter this, central banks raise interest rates, as seen recently with the Federal Reserve's aggressive rate hikes. While higher interest rates are essential for controlling inflation, they also make it more expensive for governments, corporations, and individuals to service their debts. This creates a dangerous feedback loop. As interest rates rise to curb inflation, the cost of servicing debt increases, pushing governments and businesses into deeper financial strain. High debt burdens make economies more vulnerable to market volatility, leading to potential capital outflows and devaluation of currencies in more fragile economies. In short, the world's debt problem not only makes the economy more fragile, but also traps countries in a cycle of trying to manage inflation while grappling with the ever-increasing cost of debt. The risks of defaults, economic instability, and inflationary pressures are all symptoms of an economy that has become dangerously reliant on debt. The global debt bubble. The world is caught in a dangerous cycle where governments, corporations, and even individuals are trapped in a debt spiral, constantly borrowing to service previous debts. This has created a global system where debt continues to outpace economic growth, raising concerns about its sustainability. Emerging economies, in particular, face a stark reality. Many are forced to borrow more just to meet existing obligations. For instance, in 2024, global debt surged to over $315 trillion, covering governments, corporations, and households alike. This escalating debt bubble is fragile, and if it bursts, it could trigger a financial collapse, especially for economies heavily reliant on external borrowing. Countries like Pakistan and Argentina have already experienced multiple debt crises. Dozens of other developing nations are now facing a similar risk. What happens if it bursts? If the global debt bubble were to pop, the results could be catastrophic, especially for emerging markets. These countries are often dependent on external debt to finance critical needs, and any disruption in their ability to service this debt could lead to widespread defaults. The ripple effect could spread quickly across the global financial system, leading to a crisis reminiscent of 2008, but on a potentially larger scale. Can debt be erased? Debt forgiveness or restructuring has been proposed as a solution, particularly for countries in severe debt distress. While it can offer short-term relief, it doesn't address the deeper structural issues that caused the crisis in the first place. Take Greece, for example. Despite significant debt relief, austerity measures followed, which deepened the economic struggles of its population. Another potential solution discussed by economists is inflation. As prices rise, the real value of debt decreases, making it easier to repay. However, this comes at the expense of reduced purchasing power for consumers and savers, leading to further economic challenges. While inflation might seem like a tempting short-term fix, its long-term effects on people's livelihoods and economies can be devastating. Ultimately, the sustainability of the global debt bubble is in serious question. Without substantial reforms and coordinated global efforts, this bubble might eventually lead to significant financial disruptions that affect everyone, from governments to everyday consumers. Conclusion: the global debt problem has reached unprecedented levels, with debt now far surpassing the actual money circulating in the world. This situation has largely been fueled by government borrowing, corporate loans, and international institutions like the IMF that offer financial lifelines, but often leave nations trapped in perpetual debt. As debt continues to grow, the future looks increasingly uncertain. The global reliance on debt isn't just a financial issue. It limits economic growth, creates new financial risks, and deeply impacts the everyday lives of people around the world. It's time to ask, is this debt-driven economy sustainable, or are we on the brink of another financial meltdown? Let us know your thoughts in the comments. Stay informed and see you in the next one. Thanks for watching, mate. Bye.